Hello, welcome back. So it's time to talk about PayPal, a company that was actually also suggested by one of our viewers, and it's been a company that I also wanted to take a look at myself since a long time now. I did make a video about it, it's been a long while, and lots of things have happened since then, and I believe back then I thought it was overvalued, and I never really expected to come at a point where the company's stock price could actually be an interesting purchase right now, to the point that I'm actually seriously considering myself, and I will explain what's going on here and why it's worthwhile to potentially take a look at this. And if you are a member of the tool, of course, you can be taking a look at these values yourself and also try your values at the stock evaluation tool that we're going to be doing later, because it really pays to try different values here. We're going to be looking at a company that is not very far from being a buy right now, and it really depends on which kind of risk and what kind of projections you want to be making for yourself. Let's take a little bit of a look. Now the company is sitting at 87, almost $88, down 72%. This is what happens when you are overpriced to begin with, and the stock market is at a slump. You are losing a lot of your value very quickly, and you will see that the company was at 310 at some point. It's been down massively, and it's down a lot again, and its P ratio is still 24.9. Now that can be totally acceptable for a company that's growing a lot, so that doesn't deter me from buying the company at all, especially when the price to free cash flow ratio is 19, which is something that I like to see here. Outstanding shares also going down, meaning that the company is buying back shares and not diluting investors. The opposite is happening, which is a great thing to see. And free cash flow to total liabilities is a little bit elevated, but again, as long as the company is profitable and making good free cash flow, maybe that's not too much of a concern. We don't want it to be that high though. We typically want it to be under 5 potentially, because we want a company that is solvent and can pay their debt quickly. Now for this we can also use the debt to equity ratio, although this is a little bit of a tricky one, because the debt to equity ratio applies to total debt that the company has and compares it to the equity of the company. Now actually we want to be using free cash flow. We want to be using what the company is generating in terms of their actual free cash flow to understand how much debt they have. And this is why the free cash flow comparison to the total liabilities of the company makes more sense than using, let's say, total liabilities to equity or total debt to equity. It's a little bit more inclusive, actually much more inclusive, and also introduces free cash flow into the fray. So that's important to at least gauge and know about. Now, pretty nice net income margin, not terrible, not great, of course, somewhere in between. And of course, you can do better, but I'm pretty sure their margins are a little bit low with this company. Current ratio of 1.22 as well, meaning that they have more current assets than current liabilities. Again, these are some metrics that kind of tell you how solvent the company is. It's good to have, but the one that I pay more attention to in this is this one, unless these ones are way elevated, in which case they play an important role if they are like if they are giving us an X of some sort that is like that can be really bad. Okay, so the return on assets, return on equity here looks pretty fine. Company is generating some good return on equity as well for the most part, and capital employed return is also pretty nice. Good stuff here. And next up, we're going to be taking a look at whether we have any news about the company. Of course, I always like to take a look at that. So PayPal has been cut in half by Wall Street, but uncertainty still looms as earnings approach. Q1 earnings upcoming. So I'm probably going to be making, I'm assuming, another video when this comes out. So right now we're examining it before the earnings and see whether it's worthwhile buying. Maybe even after the earnings, it would be interesting if you don't really want to be entering before the earnings or so. Okay, so let's take a look at what is going on with the actual financial statements of the company here. And you will see that from 13 billion in revenue, they grew to 25.3. Pretty nice growth over here. And the net income from 1.7 to 4.16, almost 3 times as much net income. Pretty nice. And you will see that's pretty much green every year in terms of growth. And the same thing with net income. It's only this year that has been pretty much the same than last year. This can happen in a company, of course, very normal. The companies will not be growing every year at the same rate, and some years When they grow too much, they won't be growing at all. They may actually turn negative in terms of growth. That's very, very normal. Now, we're looking at the assets of the company compared to liabilities, and we're getting the total equity from 16 billion to 21.7 billion over here. And this is a total equity that gets increased pretty nicely, not tremendously, but pretty nicely every year. So that's nice to see. They had the best years last year, pretty much. Actually, this was, 2020 was their biggest increase here, 18%, as you see from the previous year. The cash flow statement, we have our top line here of the net income of the company. Right below, we're getting the net cash provided by operating activities, a little bit of stock-based compensation and depreciation amortization. A lot of these kinds of companies, especially companies that are in the Bay Area, they pay their employees with stock. So it's what's happening here is that this is an expense that is extracted from the income statement, but it's added back to the cash flow. It's added back as cash flow, as cash provided by operating activities, because it is a non-cash expense, and the cash flow statement is all about cash expenses. It's a little bit of an accounting sort of like trick. it's normal. It's not like it's happening out of incompliance or anything. It's very, very normal, but it's worth understanding why it happens. And the same story goes with depreciation and amortization. It's not a cash expense. Capital expenditures that are about the same every year, pretty much. Normal, very normal stuff in the investing activities cash flow. And the company has been selling a lot of maturities over here, as you'll see, a lot of investments, and also acquiring some as well. So they have been purchasing quite a lot. They are doing a lot of purchasing and selling in terms of investments here. This company, of course, you can understand, I guess they are in the field of investing, of financing, of money pretty much. Cash from financing activities, this is negative over here because the company has been repurchasing stock for the most part, as you'll see. That's a pretty sight, of course, and also getting some debt over here. That's interesting as well. Much more debt in 2020 than any other year, really. Last year, pretty normal stuff, and over here, they turned negative, which is negative, generally speaking, is better. And over here, you will see that the free cash flow of the company is increasing as well, from 1.8 billion to 5.4 billion. Another pretty thing to see. They only had a slump in 2019, really, and 2016 was a year that they lost free cash flow, it looks like, based on this value. But generally speaking, they are increasing their bottom line of the cash flow statement pretty much nicely over the years. Again, not every year is gonna be the same, normal stuff. But let's take a look at the stock evaluation tool and try to deduce a price to pay. And this is where, if you actually can access the tool, if you're actually a member here, you can use your own values, of course, and play with all sorts of estimates. Now here, you will see that our revenue growth is pretty much 18 every year. That's insane, on average, of course. So I'm gonna go a little bit lower to have a little bit of a margin of safety. I'm gonna go 16, 17, and 18. And 18 is going to be my high threshold, actually. And net income margin is going to be, again, similar thing. I love when the companies do that. I love when they have the same or similar margins here, because they're very, very predictable at what they can be making and will be making in the future. I absolutely love that. So I'm going to go 15, I'm going to go 14, then 15 and 16 here. Awesome. And the free cash flow margins, a little bit more variety here, but still pretty much sitting at around, let's just say 100, 110 and 120. And annual return of 13% is what the company typically makes over here. Again, I want to be making more than 10% more, because 10% is what an S&P 500 makes over a century, pretty much. That's what the stock market produces in the US. If you are holding an S&P 500 ETF, at least that's the regular thing, and it's been so for many years. So calculate here and see what we're getting. You'll see that we are finally approaching a price that is maybe worthwhile for PayPal over here. And our low estimates are a little bit off from our current price, but not far, as you see. They're sitting at near 80 right now. And our medium ones are 97, high ones are 117, which are higher than our current price. So these are a buy here, these kinds of estimates. Now, of course, I want to be a little bit more conservative, so I would probably go with this one, yet even the medium ones are fair, because again, look at the revenue growth on average here. Every year has been 18%, at least so far, at least, that is, and this is 17%. And the net income margin that we selected to here is 15%, and the company is doing every year more than that, at least 15.3. And yeah, the margins as well. So this is fair. I think even right now, 87.78, what it is, I think PayPal actually is a buy. And I never thought I would say that for PayPal. It comes to show how far these companies can go down and actually give us amazing prices, amazing entry points. Insane. I really never expected to see that from PayPal. I may seriously consider about buying this one myself. I like what I'm seeing here, especially if it goes down a little bit more. But even if it doesn't, even at this price, I like what I'm seeing here. I really like what I'm seeing here. So yeah, again, I never expected to say that for PayPal, frankly speaking. Thank you for the suggestion. I always wanted to take a look. It's been a while now. Always a little bit of an exaggeration because I had taken a look at PayPal about a couple of months ago. But it was a while now that I wanted to take a look at PayPal again, and this was very insightful, I think, in what the company is doing. Let me know if you enjoyed the video. Please leave a comment below. Tell me what you think about PayPal. I'd love to hear your opinion. And thank you for watching this video again. I'll see you in the next one. Bye bye.